What's going on with the banking sector? Are we facing another crisis? What's happening to your money? Can you even protect it at all? We're going to talk about that today. Hello, and you got it. I've been getting a lot of questions about what's happening with the financial sector. You hear tons and tons of news about banks falling down and then some of the banks running out of liquidity. So today I decided to create an episode to give you a quick rundown as to what is happening, share with you the timeline of everything that has been happening so far and actions that you can take in order to protect your money today and going forward. So let's get started. So first off, I have this article from the Wall Street Journal, and it talks about the banking crisis, the timeline of Silicon Valley's bank collapse, and other key events. This is very important because what happened with Silicon Valley Bank, it's what kickstarted everything that is happening. So scrolling down the article, the first thing we need to do is to understand what exactly happened with Silicon Valley Bank. Well, what happened is that Silicon Valley Bank served the world of startups and their investors. As the tech industry boomed, it funneled large amounts of its surging deposits into investments such as US Treasury, which were paying low interest rates at the time. Then what happened was that the Federal Reserve began raising rates last year and venture capital dried up, leading startups to burn cash. So to meet accelerating withdrawal, SVB was forced to sell off some of its investment bonds at steep losses as yield on new bonds were much higher. So that's what happened. SVB had a lot of money in hand and they decided to invest them in US Treasuries. And because the Fed raised rates, those US Treasuries lost value. And when they sold it, they couldn't really make enough money to cover their needs. And so here is a timeline of exactly what happened. So it all started around February 24, where KPMG signs an audit report giving SVB Financial, Silicon Valley Bank's parent company, a clean bill of health for 2022. So for those who don't know who KPMG is, they're one of the biggest audit firms in the country. You might have heard of the names like Ernst & Young's and PwC. So they're among the top brands out there. Then on March 8, Silicon Valley announces it will book a $1.8 billion loss after selling some of its investment to cover increasing withdrawals. The bank says that client cash burn has remained elevated and increased further in February, leaving its deposit at the end of the month lower than it expected. And it says it plans to raise $2.25 billion by selling a mix of common and preferred stocks. The same day, Moody's downgraded SVB Financials a few hours later. Then, on March 9, SVB Financial stock crashes when the market opens, and shares of the four biggest US banks slide amid fears of the banks could be forced to take losses to raise cash. And the decline wiped out a combined $52 billion in the market value of JP Morgan Chase, Bank of America, Wells Fargo, and Citigroup. And if that wasn't enough, as the panic spreads through text and social media, venture capital firms began pulling their money out of Silicon Valley Bank and urged their portfolio companies to do the same. And by the time Silicon Valley Bank closes for business that day, depositors have attempted to withdraw $42 billion. Then on March 10, shares of SVB are halted Friday morning after a pre-market sell-off. And soon after, federal regulators announced they have taken control of the bank before it could open. This is the second biggest bank failure in US history after Washington Mutual's collapse during the height of the 2008 crisis. Then, on March 11 to 12, meaning the weekend, tech startups scrambled to line up funding sources to pay for payroll and other day-to-day operations with their deposits locked up in the failed bank. This is a horrible situation to be in if you have a business. Then, on March 12, as worries of bank runs spread through other banks, federal regulators on Sunday unveiled emergency measures to stem the fallout from Silicon Valley's bank's failure. They announced they have taken control of a second bank, Signature Bank, making it the third largest bank failure in U.S. history. Regulators say customers of both banks will get all their money back. they also announced a new lending program for banks. Then, on March 13, in a televised address, President Biden seeks to restore confidence in the financial system and stresses that the banking system is safe. Shares of First Republic and other regional bank stocks continue to slide. Then, on March 14, the Justice Department and Securities and Exchange Commission are investigating Silicon Valley's bank collapse in separate probes. And fast forward to March 15, you see the domino effect of what this created, because at this point, on March 15, Credit Suisse, which has struggled with scandals and losses over the past several years, sees its shares hit a new low as worried about the financial system spread across the Atlantic. Other European bank stocks also take hits, including SocGen, BNP Paribas, and Deutsche Bank. Now, moving along, I have another article right here. So, what really happened with Silicon Valley? I know we spoke about it at a very high level, but there's more details in here that can walk you through exactly what happened. So why did SVB fail? Well, since the pandemic began, Silicon Valley Bank had been buying lots of what are often considered safe assets like the US Treasury and government-backed mortgage bonds. But when interest rates start to rise quickly, as they did last year, their fixed interest payments don't keep up with rising interest, and those assets were no longer worth what the bank paid for them. And the bank was sitting on more than $17 billion in potential losses on those assets at the end of last year. So now, let's try to understand this whole scenario. Are we talking about a bailout, right? Were SVB and Signature Bank bailed out? Well, according to this article, it doesn't seem to be, because the two banks' uninsured depositors are receiving special government assurances. But the regulator stipulated that in the event that proceeds from the sale of the bank or its sales aren't sufficient to cover the uninsured deposits, any losses to the deposit insurance fund to cover them will be recovered by a special assessment charged to banks. Now, the question that everyone has been asking, what about the other banks? Are they all at risk? Well, while there are anecdotes of people pulling deposits from other banks, no other failures have yet emerged. At least one bank has said it has secured additional access to cash. You see, the Federal Reserve also created a new lending facility called the Bank Term Funding Program, which banks can use to borrow cash in exchange for posting certain assets as collateral. In theory, banks could use that cash to cover deposit requests. Now, another common question I've been getting from everybody, what is the Fed doing about this whole mess, right? We got bank failures, we got market turmoils. What's going to happen to the Fed rate increases, right? Because there's a lot going on out here. Well, this article from the Wall Street Journal has the answer for you. And as we scroll down, we see that more investors anticipate that the Federal Reserve rate increase cycle could be over due to broader financial turmoil from the failure of two U.S. regional banks in the past week. Investors in interest rate futures market on Wednesday saw a nearly 50% chance that the Fed won't increase rates at their March 21st, 22nd meeting, up from 30% on Tuesday, according to data compiled by the CME Group. That will lead the Fed funds rate between 4.5% and 4.75%. Now, the question that matters the most to you, is your money safe? How can you protect your money from a bank collapse? Well, according to this article by the Wall Street Journal, it says that the FDIC covers up to $250,000. But if you have $1 million, you should put your money in 4 different banks. Is that so? Well, let's see. So according to this article, at any U.S. banks, accounts with balances of up to $250,000 a person are protected. It is easy to make that $250,000 multiply. However, given that there's coverage of $250,000 for each type of account at each bank, a married couple, for example, is eligible for $500,000 protection on a joint bank account and a $250,000 for each of their individual accounts, each of them, for a total of $1 million in coverage at a single bank. So going down the list, here are potential solutions. You can open multiple bank accounts. Remember that the coverage limit for each of your accounts is $250,000. Another step you can take is to add beneficiaries to your account. According to this article, designating specific people or nonprofit organizations to inherit funds after the account's owner's death is another way to increase protection. FDIC insurance generally will cover up to $250,000 in deposits for each unique beneficiary. For example, a trust account with 5 beneficiaries will be insured up to $1.25 million. You can also do deposit swapping. And this is one way to manage the multiple accounts necessary to increase FDIC coverage by having your bank do it for you. Deposit swapping networks such as IntraFi Network LLC work with multiple banks to separate large deposits into amounts below the federal insurance limit and can protect balances up to $150 million. Using a network allows customers to get the insurance benefit of having multiple banks while dealing with only one bank. Another option is to go to credit unions. These are nonprofit financial institutions that are an alternative to commercial banking. These accounts aren't FDIC insured, but they have their own form of federally backed deposit coverage through the National Credit Union Share Insurance Fund with the same $250,000 limit. Another thing you can do is to buy bonds. Though U.S. Treasury aren't covered by the FDIC insurance, they are backed by the full faith and credit of the federal government. In other words, buying U.S. bonds is a low-risk alternative to stashing money in a bank. You can also place your money in brokerage accounts. If a brokerage fails, customers' assets should be safe, even though the accounts aren't insured by the FDIC. And for those wondering about their 401k, if a company with a 401k plan files for bankruptcy, the plan's assets are protected. The Federal Employee Retirement Income Security Act, the 1974 law that governs 401k plans, requires the assets to be held in a trust. And there you have it, details as to what's happening to the financial sectors and actions that you can take to protect your money. See you in the next video. Take care. Bye-bye.